Three local banks have reported impressive financial results with net profits growing double digits year over year. But at the same time, their share prices have shot up so fast, and DBS is even trading at an all-time high right now. So the question is, are they too high, too expensive to buy now? To answer that, we'll focus on several key metrics: price to book ratio, return on equity, and dividend yield. Here's a side-by-side comparison of the key metrics I want to cover, and I've grabbed all the latest numbers as of 13 February 2025. And this table have shown that they are now more expensive than before. So I remember when I did a YouTube video on DBS back then, it was trading at maybe 1.5, 1.6 times PB ratio. OCBC and UOB was trading at around 1 times or 1.1 times PB ratio. So from there, it has really risen by around 30 to 40%, right? As well as the ROE. So last time DBS was at 18 point something percent ROE, and OCBC and UOB were slightly higher than right now. And of course, the dividend yield. Last time they were all trading at above 5%, but when the share prices run up, the increase in dividend payouts versus their increase in share prices led to actually a lower dividend yield if you were to purchase the shares right now. Okay, so DBS OCBC is giving 4.9%, while UOB slightly lesser at 4.6%. So this is a very quick snapshot of how the three local banks stack up. Before I continue, if you're interested in getting a copy of this very beautiful set of slides, do join my free weekly newsletter at investkaki.com. I will be putting this attachment inside the weekly newsletter come this Sunday itself. Okay, so stay tuned, and I will also paste the link down in the description box below. Here are my quick thoughts when it comes to the three local banks. First of all, we understand that due to the share prices increase in the bank stocks, they have led to slightly lower dividend yields. And we all know that. But there are other things to consider as well. So, first of all, when you invest in bank stocks for their dividends, right, there are other asset classes to also consider. For example, REITs, S-REITs is a good alternative when it comes to when you compare banks versus S-REITs. Okay, reason, they also offer higher distribution yields, and there are also maybe potential for capital appreciation as compared to banks, right, which have already run up so much. The second thing is banks make their money off interest rates, right? They take their money from savers and then lend out the money to borrowers, and they earn the spread in between. So interest rate uh, policy changes will impact them quite a bit. So if you were to look at the trend right now, based on the US, interest rates are slightly coming down. Okay, so we won't know, nobody will know what will happen in future. But just based on this trend itself, because it has hit a certain peak, US is targeting for the interest rates to at least maintain and maybe come down in the near term or maybe in future. So that is pointing to a limited near-term upside potential for banks, because they have already ride the bull run for the high interest rates, and if it comes down, perhaps their profits will come down. Like a ceteris paribus, right? So if everything else stays constant and the interest rates come down, their profits will come down. And come to the last point. The last point is actually something to counter the first 2 points. Okay, so when we talk about our three local banks, they have been in the market for so long, okay, decades. And if you were to just look at how they have grown their franchises, their branding across the Asia region, I do feel that Singapore banks still offer the kind of very long term steady growth prospects because of the strong capital structures as well as the resilience they are able to offer us investors over a long period of time. Okay, so these are just some quick thoughts. I will dive into each one of them right now. Just very quick one. So first of all, S-REITs. Okay, they offer appealing, dividend yields. They may be attractive for income-focused investors, like a lot of Singaporeans. I just cherry picked a few over here. So we have OUE REIT giving us 7.5% dividend yield. CICT, we all know this, owning all the very big malls, shopping malls in Singapore, Bugis Junction, Lot 1, and the kind. Even that will give us a 5.6% dividend yield, more than what the banks are giving us already. And last but not least, we have Maple Tree Industrial Trust giving us a 6.6% dividend yield. Okay, so Industrial Trust also focus on the industrial properties as well as the data centers, which maybe is the in thing right now. So that is point number one. The second one is the interest rate sensitivity, a risk for the banks, okay, because they are skeptical to the interest rate fluctuations. All right, so we have already talked about how maybe the falling rates will compress their net profit margins and impact the profitability of the banks. Okay, and any economic slowdown will also lead to maybe some loan in quality risk, but I don't really foresee that happening to our local banks. And the last part will be a counter to the first 2 points. I know we always have to have balanced view, right? So I do see that our local banks are well positioned for steady growth in the long run because of our Singapore stable economy as well as a strong regulatory environment, as well as the third and the fourth point, which is when you look at UOB, they are growing regionally in ASEAN itself, and that is where the future growth may be. Uh, Even DBS is growing in Taiwan, in India. So their economies are growing. Unlike Singapore, maybe we are really just maybe a very slow, less than 5% economic growth as compared to other countries which can even produce double digit percentage growth in future. And the fourth point is, of course, digital innovation, which is what we are very good at, coming up with the apps, a lot of features and things like that. So all these will drive the long-term growth potential of our three local banks. So what am I trying to say, right? So what is the conclusion? It is that ultimately there's no one size fit all answer. It really depends on what you want for the investing in banks. Do you want a long-term investment where you just park money there and you don't really have to worry about it, or are you like maybe planning to go in now? So the strategy will be quite different, right? For people who have maybe bought the Singapore bank stocks maybe 1 to 2 years back, they will be sitting on quite handsome profit margins. I mean, unrealized profits, and at the same time, their dividend yield based on their cost price will be like 6, 7, or even 8%. So that is very comfortable for them. But if you were to go in now, you are looking at maybe some limited upside potential, and at the same time your dividend yield is only maybe 4+% as compared to another alternative which is REITs giving you maybe 5, 6, 7%. Okay, so ultimately you have to understand your objectives. Okay, and I think one key thing is to diversify lah. It's not say like, oh, it is a hard no. You can maybe go in a bit, and every time when the local banks. So there's one very good strategy when it comes to our local banks, right? It is that whenever they hit maybe near to the 1 times price to book ratio, like it is saying that, oh, uh it is my current market value is equivalent to all my net assets worth, right? So that is maybe the time where you can trigger your investments. And it doesn't happen quite often, but it is a, maybe a strategy that uh, you can also maybe take a look at lah. Okay. And all in all, like, remember to diversify your portfolio. It is not all into banks, and if it goes down maybe 10-20%, you will not be able to sleep at night. So all in all, like, okay, so it depends on your financial goals, and remember to always diversify.